Hello, welcome to the next in our video series on IFRS 9 for corporates. I'm Sandra Thompson, I lead our global accounting technical group, and I'm here today with Nitassha Somai. Nitassha's on secondment to my team from South Africa, where she helps our clients there. In previous videos we've been looking at financial assets. Today we're going to flip over to the credit side of the balance sheet and talk about financial liabilities. Now, the good news is that much of the guidance on financial liabilities is the same as under IAS 39. So things like how you account for bank borrowings, other lending arrangements and intergroup loans. From the liabilities side, most of that's not going to change. So before we look at what has changed, Nitassha, can you remind us of some of the basic principles when it comes to accounting for financial liabilities?
Thanks, Sandra. So IFRS 9 does not really tell us whether an instrument would be a financial liability or not. So we would continue to look to IAS 32, which is the Financial Instrument Presentation Standard, in order to do this. Secondly, financial liabilities continue to be measured at amortized cost or fair value, and it is not expected that this will change going forward. I think lastly, what's important to remember is, unlike financial assets, where we no longer need to separate embedded derivatives, that concept does not apply to financial liabilities because there isn't really a notion of solely payments of principal and interest. What this means is, on financial liabilities, you would still need to assess those contracts for the existence of any embedded derivatives and then separate if necessary. A typical example would be prepayment options found in a lot of borrowing agreements. The way you do the assessment today, you will continue to do under IFRS 9. So Sandra, I've given an overall reminder of what remains unchanged under IFRS 9. What should corporates be on the lookout for?
Well, that's a very good question, because I think many corporates think there are no changes for liabilities under IFRS 9, but actually there is one big change that you need to be aware of, and that's debt modifications. What do I mean by a debt modification? Well, that's when the terms of a debt instrument and liability are changed, but the changes are not so significant that they result in derecognition of that liability and recognition of a new one. Now, for those debt modifications, the Board and the Interpretations Committee have recently confirmed that you will now get a gain or loss at the time the terms are changed. That gain or loss is calculated as the present value of the difference between the old terms and the new terms, discounted as the original effective interest rate. And this will potentially be a big change. Under IAS 39, you had to do that same calculation between the old and new terms, but the difference that arose was often spread forward by adjusting the effective interest rate rather than taken as a day one gain or loss. So Nitassha, can you tell us a bit about when this change will apply and what should companies be doing now?
Thanks, Sandra. So, as Sandra mentioned, spreading the gain or loss over the remaining term of the liability will no longer be allowed under IFRS 9. Does this mean I need to change my current accounting under IAS 39? Not at all. However, the accounting going forward once IFRS 9 is adopted needs to be considered. IFRS 9 has retrospective application. This means I need to adjust the opening balance of retained earnings when I first adopt IFRS 9. So any gains and losses that I have on financial liabilities that were restructured before the adoption of IFRS 9 would need to be adjusted against the opening balance of retained earnings. For example, if I have a year end of 31 December 2018, on 1 Jan 2018, when I first apply IFRS 9, I would need to make an adjustment against the opening balance of retained earnings. Now, this can have a significant impact on finance costs recognized in the income statement going forward once IFRS 9 does become effective.
Thank you, Nitassha. That's very clear and certainly food for thought. So just to recap, overall the model for financial liabilities hasn't changed. There are still two categories, fair value and amortized cost, and you still need to look out for embedded derivatives and separate those where required. However, there is one big change when it comes to debt modifications. Under IFRS 9, the difference that arises on a debt modification will need to be booked day one as a gain or loss and can no longer be spread forward. Thanks for listening. I hope you'll join us next time, and if you'd like to subscribe for the whole series, please click on the button at the bottom of your screen. Bye-bye.